Good evening, everyone. Welcome to the John F. Kennedy Jr. Forum at Harvard Kennedy School. I'm Doug Elmendorf, the Dean of the Kennedy School. I'm glad to see all of you here tonight. We are presenting the 2017 Malcolm Wiener Lecture on International Political Economy. We are honored and delighted that the lecturer tonight is Lael Brainard, a member of the Board of Governors of the Federal Reserve System. Let me briefly introduce this lecture and our speaker. The Wiener Lecture is one of the Kennedy School's most prestigious lectures. It was established nearly 30 years ago through a generous gift of Malcolm Hewitt Wiener. Malcolm is an amazing person whom I've had the chance to get to know over this past year. He was an economics concentrator at Harvard College and then founded and led a very successful investment firm. But Malcolm is also a widely recognized, respected, and published author on Aegean prehistory. Malcolm sends me his papers sometimes, the latest of which is titled The Population and Depopulation of Late Minoan Crete, which describes, analyzes the dramatic swings in the population of that society. Malcolm has a very touching belief that I will understand this work when he sends it to me, and I try, although alas, I think his confidence is a little misplaced. But among Malcolm's many interests and commitments in his life, we are very fortunate that the Kennedy School has been a quite important one. He is one of the most steadfast and important supporters of the Kennedy School now for 3 decades. Without his generosity, we would not have the tremendous work of the Wiener Center for Social Policy, now led by David Ellwood, my predecessor as dean. We would not have the Malcolm Wiener professorships, the Wiener Auditorium, or this lecture. So my colleagues and I are extremely grateful for all that Malcolm has done to advance the mission of the Kennedy School. Unfortunately, Malcolm is nursing a temporary illness and could not be here tonight. I'm very pleased, though, that his daughters, Kate and Elizabeth, could be here. They are students in other parts of the university and are very accomplished in their own rights. And we're glad to have you here to represent your father and your family. The past Wiener lecturers have been very distinguished. They include Muhammad Yunus, the 2006 Nobel laureate and founder of the Grameen Bank, Gordon Brown, former Prime Minister of the UK, Mario Draghi, the President of the European Central Bank, and Hank Paulson, former Secretary of the US Treasury. Tonight we are thrilled to have another distinguished policymaker and public leader here to give the Wiener Lecture, Lael Brainard. I met Lael in graduate school here at Harvard, and you could tell then that she was destined for great things, which has turned out to be true. After graduate school, Lael went on to join the faculty of the Sloan School of Management at MIT. She then served as deputy assistant to President Clinton, where she was his personal representative for the G7 and G8 meetings. Lael later joined the Brookings Institution. She was a vice president and the founding director of the Global Economy and Development Program. Lael went to the Treasury Department in the Obama administration, where she was Undersecretary for International Finance. In that role, she was the U.S. representative to the G20 finance deputies and the G7 deputies, and a member of the Financial Stability Board. Lael became a governor of the Federal Reserve in 2014, nearly 3 years ago. We could not ask for a better person to present the Malcolm Wiener Lecture on International Economic Policy than Lael Brainard. And I will close my introduction with a personal comment that I feel very lucky to have been Lael's friend for many years now, and I feel very lucky to welcome her to the Kennedy School tonight. Lael Brainard.
Well, it's a real pleasure to be here, and it's nice to see friends here. Boy, that was incredibly kind, Doug. Doug was one of my favorite graduate students, and I was not destined for greatness. I would not have made it through graduate school but for his assistance and coaching. And I'm also very honored to be invited to deliver the Malcolm Wiener Lecture, and I am Sorry he can't be here in person, but I think he should feel proud that he's so well represented by his daughters. Today I wanted to talk a little bit about the outlook for the economy. The economy appears to be at a transition. We're closing in on full employment. Inflation is moving gradually toward our target. Foreign growth is on more solid footing, and risks to the outlook are as close to balanced as they have been for some time. All told, it will likely be appropriate soon to remove additional accommodation, continuing on a gradual path. As normalization of the federal funds rate gets further underway, monetary policy too is approaching a transition, prompting increased focus on the balance sheet. How the federal funds rate and the balance sheet should be adjusted individually and in combination depends on the degree to which they are substitutes, their relative precision, and the degree to which their effects on the economy are well understood. So let's start with the outlook and then turn to policy. In recent quarters, we've seen improvement in inflation and activity both at home and abroad, following a period when the drag on domestic activity from abroad was considerable. Between the middle of 2014 and 16, a combination of notable fragilities and risks in large foreign economies, elevated sensitivity of the dollar to policy divergence, a sharp decline in oil prices, and heightened financial market sensitivity combined to slow progress in the U.S. economy and the adjustment of monetary policy to an extent few had anticipated. Today, the external environment appears more benign than it has been for some time, even though risks remain. Recoveries are gaining traction in China, Japan, and Europe, in part reflecting greater confidence in their respective policy environments. The improvement in the global risk outlook was also helped by the continued progress and the gradual pace of monetary policy adjustment in the United States last year. In recent quarters, market participants appear more confident that China has the will and the capacity to maintain its exchange rate regime while achieving its growth targets, although there's a tension with high credit growth that will eventually need to be addressed. In response to weak growth, downward pressure on the currency, large capital outflows, and financial market volatility early last year, Chinese authorities boosted the supply of credit, ramped up fiscal stimulus, initiated new communications regarding the exchange rate, and clamped down on capital outflows. These actions appear to have stabilized growth and calmed fears of financial instability. Capital outflows, while still significant, have moderated. Activity in Japan has also picked up recently, and monetary policy has remained supportive. In Europe, the recovery has proven to be increasingly resilient. Monetary policy has continued to provide crucial support. Several challenges, including referendums in the United Kingdom and Italy, and liquidity and capital stresses faced by German and Italian banks, have so far been navigated without significant damage to growth, financial stability, or inflation expectations. Financial markets have functioned reasonably well, and risk spreads have stayed contained, although uncertainty about upcoming elections has likely led to some increase in French and Italian sovereign spreads in recent months. Measures of inflation compensation have also improved, suggesting fears about disinflation have diminished. Of course, concerns regarding the medium to longer run remain. In China, the price of near-term stability has been an increase in leverage, particularly in the corporate sector. In Japan, core consumer price inflation is close to zero, well below the central bank's 2% target, and limited scope for additional monetary policy accommodation leaves the economy vulnerable to shocks. In the euro area, growth and inflation may remain low for some time, which would pose challenges for banks with low capital or high amounts of non-performing loans, and for highly indebted sovereigns. And political events raise some uncertainty. Going forward, it will be important to continue monitoring these developments. Here at home, the economy is at a transition. The past few months have seen continued progress in the labor market, and we appear to be closing in on full employment. The unemployment rate, after remaining relatively flat from the third quarter of 2015 to the third quarter of 16, fell 1/4 percentage point last quarter to 4 3/4%. The labor force participation has been about flat on net over the past 2.5 years, which indicates considerable cyclical improvement given the underlying demographic trend. And compensation per hour in the business sector, the most comprehensive measure of wages, increased at a 3% pace the past 2 years, noticeably above the pace earlier in the recovery. Even so, there may be some room for further improvement on some margins. The prime age employment to population ratio remains depressed relative to pre-crisis. The share of workers who are working part-time who would prefer full-time jobs is still elevated. And some measures of wage growth, notably the employment cost index, have increased relatively little. We're seeing welcome signs of progress also on the second leg of our mandate, of our dual mandate, after a protracted period below the FOMC target of 2% inflation. Recent months have seen a step up in longer-term inflation compensation, which had dropped to worrisomely low levels last year. Both market-based and some survey-based measures of inflation expectations remain low, but there's been some movement in the right direction in the past few months. Inflation has also moved up lately as the effect of past decreases in energy prices and increases in the dollar has faded. Core PCE inflation, which strips out volatile food and energy prices and is a good gauge of future inflation, has increased. Still, core inflation has been below our 2% target for almost all of the past 8 years, and further progress is necessary to reach and sustain our symmetric inflation target. Recent indicators of aggregate spending suggest we will continue to edge closer to our goals. Consumption growth has been encouraging, supported by continued job gains, rising wealth, and greater confidence. Business investment changed little the past 2 years, but there are some signs of renewed growth currently. This is a sharp contrast with the situation just a year ago when risk spreads on corporate bonds had risen noticeably. These are often a precursor to downturns. Measures of business sentiment were relatively depressed, and corporate profits had declined over 10%. In recent quarters, risk spreads have moved back down to more normal levels. Business sentiment has rebounded. Economic profits look to have turned up, and new orders for capital goods are moving higher. The partial rebound in oil prices has also given a boost to drilling activity. Of course, there are some cross-currents that could weigh on activity. Recent increases in longer-term interest rates could restrain interest-sensitive areas of demand, such as housing, and a further pickup in the dollar could weigh on net exports and business investment. Upside risks to domestic demand have increased. Equity prices are up around 10% since October. Sentiment has increased, although the spending data don't yet show a noticeable acceleration. Some of the increase in sentiment and changes in asset prices could be tied to expectations of more expansive fiscal policy, which is another upside risk. In addition, the progress that we've made over the past year, with the economy closer to meeting full employment and inflation objectives, has contributed to the favorable shift in the balance of risks. This increase in upside risk to domestic demand and the diminution of foreign risks suggests that risks to the outlook are more balanced today than they have been for the preceding 2 years. Even so, the nominal neutral rate of interest, the level of the federal funds rate that's consistent with output growing close to its potential, with full employment and stable inflation, the rate that's neither contractionary nor expansionary is expected to remain low in the near term and below its historical average even once it reaches its longer run normal level. This means there'll be less room to cut the federal funds rate so that the likelihood of returning to and operating near the effective lower bound will remain higher than we're accustomed to historically. Prudent risk management suggests that policy should take that into account, this asymmetry in risks posed by the greater likelihood of being at the effective lower bound where conventional policy can't cut further. Given the progress we've seen and the positive momentum in the incoming data, additional removal of accommodation is likely to be appropriate soon, continuing at a gradual pace. But unlike in previous tightening cycles, The FOMC currently has two tools to remove accommodation, the balance sheet as well as the federal funds rate. The December 2015 decision by the committee to continue to reinvest principal payments and thus to rely solely on the federal funds rate to remove accommodation until normalization is well underway serves a very important purpose in my view. With the asymmetry that I talked about earlier in the scope for conventional monetary policy to respond to shocks, there's a benefit to enabling the federal funds rate to rise more quickly than would be possible if the balance sheet were shrinking at the same time, and sooner reach a level that allows for significant reductions if conditions deteriorate. Even so, recognizing that the median of the committee projections places the long-run value of the federal funds rate around 3%, which is a very low level by historical standards, some could judge normalization to be well underway before too long. So monetary policy, too, could be approaching a transition point. Once the short-term rate is comfortably distant from its effective lower bound, there are broadly two types of policy strategies that could be contemplated. One type, let's call it a complementarity strategy, might actively deploy the balance sheet as an independent second tool complementary to the short-term rate. Under this strategy, both tools would be actively used to help the committee achieve its goals. This strategy would seek to take advantage of the way in which the balance sheet might affect certain aspects of the economy or financial markets differently than the short-term rate. Any such difference might derive from the fact that the balance sheet more directly, though not necessarily more precisely, affects term premia on longer-term securities, while the short-term rate more directly affects money market rates. Although it may be tempting in theory to operate with the balance sheet as a complementary additional tool, we have virtually no experience with how such an approach would work in practice away from the effective lower bound. For this reason, one might instead prefer a strategy, let's call it subordination strategy, that would prioritize the federal funds rate as the sole active tool away from the effective lower bound, effectively subordinating the balance sheet. Once federal funds normalization meets the test of being well underway, triggering an end to the current reinvestment policy, the balance sheet would be set on autopilot, shrinking in a gradual, predictable way until a new normal has been reached, and then increasing in line with trend increases in the demand for currency after that. Under this strategy, the balance sheet might be used as an active tool only if adverse shocks push the economy back down to the effective lower bound. The case for this strategy is straightforward and I think compelling. This strategy recognizes that the two policy tools are broadly similar away from the effective lower bound in the ways that they affect the economy by indirectly changing the level of interest rates used to finance purchases by households and businesses. Relative to balance sheet policies, however, the influence of the short-term rate is far better understood and extensively tested. We've had several decades and many business cycles over which to measure and analyze how the federal funds rate affects financial markets and real activity. In contrast, experience using the balance sheet as an active tool has been largely confined to a highly unusual period around the global financial crisis when short-term rates were constrained by the effective lower bound. So predictability, parsimony, precision, and clarity of communications all would seem to argue in favor of focusing policy on a single active tool that's most familiar. In short, it makes sense to focus policy on the tool whose effects are better understood by both policymakers and the public in circumstances where the tools are largely substitutes. Even with this subordination strategy, there may be limited circumstances in which the balance sheet might be employed in a manner that's supportive of the short-term rate. Most obviously during the period when the balance sheet is running down, if the economy again encounters adverse shocks, it may be appropriate to commence the reinvestment of principal payments again in order to preserve conventional policy space if the federal funds rate were to drop below some threshold level, perhaps similar to the one that we determine is well underway. More broadly, although the two tools can achieve roughly similar effects, they are different. And there may be special circumstances under which these differences may be particularly valuable, such as when the transmission of changes in the short-term rate to long-term rates and other financial market variables and the real economy is impeded. Moreover, in addition to directly affecting longer-term rates, changes to the balance sheet could serve to reinforce policy communication associated with the short-term rate through signaling, as some have suggested happened during the global financial crisis. Assuming that this subordination strategy is adopted and the balance sheet is set to shrink passively and predictably once reinvestment ceases or is phased out, there's some uncertainty around the size of the balance sheet when it returns to normal. There are good reasons to expect the new normal balance sheet to be considerably smaller than its current size, but larger than its pre-crisis level. Of course, trend growth in the demand for currency gradually pushes up the size of the balance sheet over time. But in addition, the structural demand for reserves may be considerably larger now than prior to the financial crisis because of changes such as new regulations that favor safe liquid assets and changes in financial institutions' attitudes towards risk. If the demand curve for reserves has shifted out, then a greater supply will be needed to attain any given interest rate. And the supply of reserves will need to be set far enough above the structural level of demand to accommodate unexpected shocks. Because of changes since the crisis, it's difficult to know with any precision how low reserves can be allowed to drop while still maintaining effective interest rate control. So as the balance sheet gradually declines, it'll be important to carefully monitor money markets for indications that any further reductions in the supply of reserves could put upward pressure on money market rates. So let me just quickly sum up. Recent developments suggest the macroeconomy may be at a transition, with full employment within reach, signs of progress on inflation, and a favorable shift in the balance of risks at home and abroad. It will likely be appropriate soon to remove additional accommodation, continuing on a gradual path. As the federal funds rate continues to move higher towards its expected longer-run level, a transition in balance sheet policy will also be warranted. These transitions in both the economy and monetary policy are positive reflections of the fact that the economy is gradually drawing closer to our policy goals. How the committee should adjust the size and the composition of the balance sheet to accomplish its goals, and what level the balance sheet should be in its new normal are important subjects that I look forward to discussing with my colleagues. So with that, let me conclude and open it up for questions. Thank you.
Thank you so much, Lael. The floor is open for questions. There are microphones on these two sides on the ground floor and microphones up, partway up of those stairs. As usual at the Kennedy School Forum, we like people to identify who you are when you start, to ask a short question, and to make it really a question. So I'm just going to point, but Lael will have to do the hard part of answering the questions. Sir.
Hi, thanks so much for coming. My name is Eric Hollenberg. I'm a senior at the college studying economics, and I'm just wondering, so last time there was significant fiscal expansion, interest rates were low, and they had been low, and it seemed that they were going to be low for a while. Now with this new talk of possible fiscal expansion, it seems like rather than going into an easing cycle, which the Federal Reserve was actively doing in 2009, it seems like it's more, the balance is more towards a tightening cycle. So I'm just wondering how you and the rest of the governors view that, view fiscal expansion in the face of different interest rate cycles.
Yeah, so it's a really important distinction. How fiscal policy affects the economy depends on a lot of things. And of course, there's a lot of uncertainty about precisely what the magnitude of the policies might be, what their composition might be, and what their timing should be. But one of the things that matters greatly for the effects of fiscal policy on the economy is how far the economy is from its goals of full employment and inflation. And as I think I laid out in very extensive detail, I'm sure you don't want me to repeat it, I do see the economy as approaching. It's in the vicinity of full employment, and we're starting to see some progress on inflation. So in that kind of a context, fiscal policy that operates primarily to expand aggregate demand might lend itself to an expansion in fiscal spending. It may improve the outlook on inflation, for instance. But if there is not much change to potential growth or to aggregate supply, all else equal, it would tend to push in the direction of being consistent with greater inflation and thereby with greater increases in the trajectory of the interest rate. In those circumstances, the fiscal space is the real issue of whether that fiscal space, how much fiscal space there is, and how much fiscal space will be maintained to cushion the economy should at some later point it encounter adverse shocks. But again, these are pretty theoretical in the sense that right now we don't really know when or what or how much fiscal there might be coming down the pike. There's a lot of steps in that process.
Thank you.
Thank you.
Hi, my name is Ryan, and I'm a sophomore at the college. I was wondering what your thoughts are on the Fed's current level of credibility and whether you think this could be a problem moving forward.
So the Federal Reserve has a very clear set of statutory requirements that it operates under. Congress essentially determines how the Fed operates. We get from Congress very clear objectives for monetary policy, a lot of clarity around what instruments we use to achieve those. And then we operate under, I think, the highest transparency practices and standards really of any central bank in the world. As I'm sure you know, every word we say in the FOMC is captured for posterity, and it's summarized first in the consensus statement, then in the minutes, and then finally released in transcript, complete with pauses and laughter 5 years later. We tend to come to places like this and try to give the public a sense of how we're thinking about where the economy is relative to our goals and how that affects our policy outlook. And of course, we testify quite a bit in front of Congress. So I hope that our messages are pretty clear, and I hope that that will help undergird strong credibility as well.
Hi, my name is Vince. I'm a junior at the college. This is a little bit more of a theoretical question, but you mentioned in your talk about the issues of the zero lower bound. And a lot of people think a big obstacle to negative interest rates is the ability of cash. At the same time, a lot of economists talked about how cash enables a lot of crimes like tax evasion, money laundering, and drug dealing. So theoretically, why wouldn't the Federal Reserve want to limit the amount of cash in circulation, at the same time allow them to push negative interest rates lower and potentially kind of solve a lot of those crimes that are facilitated by cash?
Yeah, so it's a really interesting debate, and in fact, some eminent economists at this very university have proposed something along the lines that you suggested, and I will say that I can speak for myself. First of all, my great preference is to give sufficient support to the economy and be sufficiently patient when the economy encounters shocks, as it did over the last 2 years, to ensure that we continue to make progress towards our goals. And because conventional policy space, using the federal funds rate above that zero lower bound or the effective lower bound is so much better understood, more familiar, easier to communicate, and something that financial market participants have many years of experience with. My inclination is to be very cautious from a risk management point of view and to try to remain in that realm. The discussions about negative interest rates, I think, have been given a lot of additional real-world testing over the last few years, which we have followed with great interest, as we should, because these are policies that other central banks have undertaken. And I think we have learned that many economies have found that moving somewhat negative, not deeply negative, but somewhat negative can be effective at extending that policy space, but it's not something that I think we need to be contemplating now. And the issues associated with electronic issuance of currency go well beyond issues simply of creating additional policy space and have a lot of very complicated considerations associated with them.
Thank you.
Thank you so much for speaking with us today. My name is Martin Chorzempa. I'm an MPA ID student, and if I may, I'd like to ask a question not about monetary policy, but about one of your other specialties at the Fed, which is financial technology, and the way that you envision the role of the Federal Reserve versus and in collaboration with the other regulators in the system, like the OCC, moving forward to take on the challenges of changes in structure and regulatory adaptations that need to happen for these changes.
So the area of financial technology, I think, is an area that we as regulators, as responsible for some parts of the payment system with responsibilities on financial stability and for overall safety and soundness of the banking system, as well as for some consumer protection for some of parts of that system. For all those reasons, the Federal Reserve really has a responsibility to be very engaged in learning everything we can about what's happening, both in the consumer and small business facing side of financial innovation, but also on the back end, where distributed ledger could ultimately be transformative in terms of the way that wholesale financial markets operate. So we have people all over the country because of our 12 bank system. So in some of the most innovative parts of America. So we get a lot of really good market intelligence from that. And, you know, I think it's early days yet. It's hard to look around the corner and see exactly how structure is going to evolve. One thing that does seem clear is that people of your age will probably go to a branch once in their lives, if that, and will do almost all of their financial interactions on their smartphones. And already many people are there. And so the questions are, you know, how do some of the financial technology companies interact with banks? What's the safety and security of that? What's the role for applications programming interfaces in that? It's all very early stages. What's the responsibility of the various regulators? We're not, I don't think, in a place yet, because this is so early stages, of being able to come to firm policy conclusions. And it's true also of the other bank regulators. You're right, they've put out some proposals, but I'd say it's good to have a very robust debate, but it's still pretty early to know what the right answer is for some of these very complicated issues.
Thank you.
Thank you.
Hi, Zach Dynan, senior at the college studying economics. So you mentioned that the long run federal funds target is 3%, which is much lower than usual in normal times. Is there a fear that, like, come another negative adverse shock to the economy, we're going to be back at the zero lower bound? And given our lack of experience using the Fed's balance sheet in dealing with these experiences, is there any talk of potentially giving more power to using the short rate to provide stimulus to the economy by increasing the inflation target to, like, say 3 or 4%?
So it is true that the median projection for the committee is around 3% now. Obviously, there may be some dispersion about individual members' views about that, but there's also a lot of research out there which would suggest that we may be seeing the neutral rate remaining low for some protracted period of time due to a whole variety of things, demographics, low productivity growth, maybe changes in risk attitudes, as well as some global influences there. You're exactly right. In that kind of a world, if you just had the same severity and frequency of shocks as we've experienced historically, you would be bumping down against that effective lower bound more frequently. And so it does raise questions about how adequate our tools are for responding. Where it leads me personally is to be somewhat cautious and to be very mindful of the asymmetry in our conventional toolkit. Again, I have a bias in favor of sticking with what we really understand well. And for that reason, I have been somewhat asymmetric in my risk management approach over the last few years.
Hi, first of all, thank you very much for coming. My name is Nick. I'm a freshman at the college. I'm undecided, but heavily leaning towards economics. So my question is less macroeconomic and more political, I guess. The president has indicated that he's strongly considering replacing Chairwoman Yellen at the end of her term. And I was just wondering how you anticipate that affecting, if that does come to pass, the Fed's work and its approach to macroeconomic policy in the next decade.
Well, I hope my remarks did not deter you from pursuing undergraduate economics, because much more interesting than monetary policy speeches. In terms of potential personnel changes at the Federal Reserve, I mean, we have a very strong institutional framework. Again, our objectives are extremely clear. They're given to us by Congress, and we operate under statutory authority. And there's a lot of guardrails in the system. As you know, it's a voting institution that votes with a great deal of transparency, but there are very clear voting rules, which means that you have collective decision-making to a certain degree. And we look at the same data. We have phenomenal staff who present the forecast and do a lot of analysis that is given to all members of the committee and helps inform our thinking in a similar way. So for all those reasons, the Federal Reserve, I think, has been set up by statute to essentially ensure quite a bit of continuity over time. Now, I can't predict with any certainty what particular changes might lead to, or whether there will be any changes. But again, just from an institutional perspective, there's a lot of guardrails that push in the direction of continuity.
Thank you.
Thank you.
Hi, I'm Avi from the business school. So the Dow hit 21,000 today. If you were to look at the Shiller price to earnings ratio, it's hovering around 30 versus the long-term median of 16. So my question is, a lot of folks would attribute this to the long-term or a long time of protracted low interest rates. If we do find ourselves in a situation as we're increasing, trying to increase interest rates, that we are in an asset bubble and that bubble were to burst, do you see that as like a legitimate risk, and what kind of room would we have for accommodation given how low interest rates are today?
So first of all, it's one thing I have learned over many years of working in this arena is it's very hard to predict. It's impossible to predict how financial markets are going to move over time. But since the crisis, and in part due to statutory changes in Dodd-Frank, the Federal Reserve Board has more explicit responsibilities for financial stability. I think it's always had responsibilities for financial stability, but they have been much more explicit since the crisis, and I think for good reason. As a result, we now have a committee that focuses on the kinds of issues that you raised on the board, but we also have a new division that's devoted to it. And they do systematic, proactive monitoring of risks in a way that we really didn't have in the lead up to the crisis. So we look at precisely the kinds of things that you're asking. Are valuations looking a little stretched? And to the extent they are, is it in particular markets? As you said, some asset valuations have been rising. But we also look at the combination of factors that seem to be important during the crisis. So it wasn't simply asset valuations leading into the crisis. It was a combination of that along with leverage and maturity transformation. So, we are carefully monitoring across that spectrum of risks, and we're doing it sort of market by market. And what I can tell you from that work is that Maturity, transformation, and leverage are very different than they were going into the crisis, and really are not flashing any kind of concern signals. But we will continue watching that. Now, in terms of what tools do we have, we are better equipped and less reliant on a single tool of monetary policy. So we have a counter-cyclical buffer that gets turned on when many of those metrics start flashing signals of concern and can build over time. But we also have, through the cycle, structural kinds of safeguards. As you know, the largest banks have much larger capital buffers. Those are stressed every year. They're doing much more risk management. They are husbanding their liquidity much more carefully. We have living wills. So there are a whole variety of safeguards now that go along with those counter-cyclical measures that would also move in the direction of helping us contend with any financial stability risks without relying on that sole policy instrument of the federal funds rate.
Thank you.
So can I build on that and interject a pair of questions?
I thought you were going to make some observations.
No. This is for you. Can we talk about Dodd-Frank a little bit? So you just referred to some of the changes in the way the Federal Reserve operates since the crisis. Obviously, there's been very important changes by law in Dodd-Frank. And Dodd-Frank is explicitly on the table for changes from the new administration and the Congress. So I have two issues I wanted to ask you about. One is the importance in your mind of orderly liquidation authority. Former Chairman Ben Bernanke just wrote a piece emphasizing how important he thought that authority was in his view. And the second piece is, are you concerned that the extra restrictions on lending that came about through Dodd-Frank and other changes have made getting credit unduly hard? Right? There's often a pendulum that's discussed in terms of credit availability. Do you think that pendulum has now swung too far?
Yeah. Well, let me just say that, first of all, we just got more data yesterday that shows that credit conditions are really good, that banks are lending, banks of all sizes are lending, have been for some time, and that conditions in credit markets are at least as good as they were pre-crisis. Without some of the riskiness, and that profitability has also been improving over time. So what we see is a group of the largest and the very large, most complicated institutions have built substantially more capital. They're managing liquidity much more carefully. The derivatives markets are much more transparent, and there's been a lot of very important changes there. And those banks, which have made the most fundamental changes since the crisis, because I think the US regulatory system moved quicker in the wake of the crisis, and our standards are at least as strong as anywhere else in the world, those banks are lending more, are more competitive and more profitable than banks in any other part of the world. So I think it does suggest that the more sort of better capitalized, better risk managed, better liquidity managed institution can actually lend and succeed and be profitable. In terms of the particular aspects of Dodd-Frank that you asked about, I do think that orderly liquidation authority is one of the absolutely most critical pillars of Dodd-Frank. Now, it goes hand in hand with the enhanced prudential standards, the tougher requirements, the surcharge and other things that have been imposed on the larger institutions. And it does absolutely depend on those institutions having credible living wills, and those are pretty tough tests that those living wills need to pass. But if there's one thing we learned from the crisis, it is that risk of having multiple large institution failures at the same time is one that is incredibly damaging to the economy, and we need a mechanism like orderly liquidation authority to ensure that taxpayers are never again on the hook for those kinds of failures.
Thank you. Please.
I'm Julia Arnus. I'm a 2011 graduate of the college. There are various academic efforts underway to sort of evaluate and analyze crisis interventions and develop a toolkit for responding to financial crises and sort of firefighting. What guidance do you have for academics who are trying to develop resources that would actually be useful and that central bankers could turn to in times of crisis?
Well, I think one of the other important lessons from the crisis is that, at least in the US and in other major financial jurisdictions, wholesale financial markets are really the nerve centers of the financial system. And just as the central bank has a long tradition of playing a role as lender of last resort through the banking system, so too being able to intervene again, as with classic lender of last resort doctrine against good collateral, with solvent institutions to liquefy those wholesale financial markets is a critical lesson from the crisis. And the ability of the Federal Reserve to do that during the crisis, I think, was vital in ensuring that the crisis was contained, that the fire essentially was contained. Doug's question about orderly liquidation authority also goes to that essential toolkit for moments where very large, complicated, interconnected firms that have cross-border operations might together be on the verge of failure. And so they are being able to liquidate them in an orderly way, again, without taxpayer funding is critically important. But perhaps the most important thing is preventing that crisis to begin with. And that's why massively lowering the probability that any of those institutions ever get to that point is sort of job number one.
Thank you. Yes.
Hi, my name is Kezia, and I'm a student at the college. And my question is, what do you find most exciting or interesting about your job?
I am, as you can tell, an enormous wonk. And there is not a subject that you ask about at the Federal Reserve where you do not find 10 members of the staff who have written original, really interesting research on it, and they are only too eager to come and tell you everything they know. So that's the best thing about the Federal Reserve. It's just this incredible group of staff, whether it be, in the supervision area. I mean, it's really payments, financial technology, of course, monetary policy, financial stability, how the wholesale financial markets work, how the international spillovers work through exchange rates. I mean, you ask any question and you get incredible depth and nuance. So that's probably the most exciting part. I find it very exciting when young people like yourself come and do internships, and I would really encourage you to think about that. It's a phenomenal place, I think.
Yes.
Really, you get great access, and that also helps keep, it can be a bit stodgy, especially in the hall on which I sit, which is marble and old and quiet. So I would really encourage people, of your generation to apply and to come kind of give us a little jolt of energy.
Thank you.
Thank you. So let me ask one more question, if I might, which is about the costs and benefits of running the economy hot. So the unemployment rate is now a little below 5%. It's at roughly what many people think is the natural rate of unemployment. So there's some sense that maybe we should stop this there. But you noted that during the past several years, the labor force participation rate, which has been trending down, has actually been roughly level. So there's been a real increase in participation on cyclical terms, as you said, I think because the unemployment rate has been fairly low and falling, wage growth has started to pick up. So if we let the unemployment rate, if you and your colleagues let the unemployment rate fall to 4%, say, I think that would draw more people into the labor force or keep more people in the labor force. And given even if the natural rate is 5%, the unemployment rate of 4% isn't going to push inflation up very far, very fast. So I think the modeling of the Federal Reserve staff, of whom I was once a member and did the sort of work that Lael's talking about, the staff would say you could run the unemployment rate, I think, at 4% for a number of years before the inflation rate would actually get back to 2%, barring other sorts of shocks. You said 2% is a symmetric target, and you also said that the Fed has watched the inflation rate being below that target almost continuously now for years. So why not let the unemployment rate go down to 4% and stay there for the next several years?
So I think I don't view it from that perspective. I think there is a lot about the economy that has changed. Perhaps it was changing going into the crisis, but it certainly appears to have changed since the crisis. And we don't really know what the natural rate of unemployment is. As you said, many people thought we had reached it a year ago. And instead of seeing unemployment moving lower over that period, it flattened out, and many people who thought that labor force participation was tapped out and that the demographics really were going to lead to structurally much lower labor force participation, found that, in fact, people did come back into the labor force. And so we saw a flattening out rather than a continued decline, which would have been more consistent with the demographic trend. The part-time, people that are working part-time but say they want a full-time job, I don't think we fully understand. Is that a cyclical phenomenon? Are they still looking for that full-time job? Or is it that the nature of work is changing? With a lot more contracting out, a lot more temporary arrangements, some smaller, but some of these gig economy arrangements. So I think there are a variety of reasons to think that we aren't actually as knowledgeable about the natural rate of unemployment as we think we are. And as you said, because inflation has been so sort of for such a protracted period of time below its target, there hasn't really been any tension. Now, going forward, obviously, those dynamics could change, and so that's what we'll all be watching very carefully. I certainly will. But again, I think the economy is at a bit of a transition point. The international environment poses less downside risk. The domestic environment poses more upside risks. So we are going to be in a slightly different kind of posture, I think, going forward.
Thank you so much. I think we've now run out of time. Lael, thank you so much. We've learned a lot tonight. We really appreciate your coming. Thank you.